Hello, everyone, and welcome to the 11th episode of the Startup Boston podcast. Today, I sit down with Rob Go, co-founder and partner at NextView Ventures, a seed-stage VC firm focused on internet and software businesses, investing in both business-to-consumer and business-to-business companies. NextView has investments in companies such as Drift, InsightSqaured, Bridj, and TaskRabbit. Before founding NextView, Rob was at Spark Capital and focused on early-stage consumer web and mobile companies. Prior to Spark, Rob worked at eBay as the business product lead overseeing the launch of products that enhanced the search, browse, and discovery experience for millions of users. NextView believes in being great at one thing: high conviction, hands-on seed investing. In this episode, a few things that Rob shares are the 3 problems with VC, what growing up abroad taught him about running a company, how early-stage startup valuations have changed over the last 10 years, and why a smaller seed round can be better than a larger seed round. In this week's book giveaway, I'm giving away The Power of Habit: Why We Do What We Do in Life and Business by Charles Duhigg. The book is really one of my all-time favorites and has spent over 60 weeks on the New York Times bestseller list. In the book, Charles talks about why habits exist and how they can be changed. The Power of Habit uncovers how the key to exercising regularly, losing weight, being more productive, and achieving success is understanding how habits work. To enter into the giveaway, make sure you subscribe and leave a review of the podcast on iTunes. Enjoy today's episode. Rob Go, thank you so much for coming on the show today.
Yeah, thanks for having me.
Everyone I talk to speaks very highly of you, so I'm really excited.
Thank you. It's very kind.
Before we start, just give us a little background about yourself.
Where should I begin? I'm the quick background. I'm one of the co-founders and a partner at NextView Ventures. We're a seed stage focused venture capital firm based here in Boston. We started the firm about 6 years ago, and we focus on investing in companies at the very earliest stages, going after technology-enabled innovation.
What did you do before NextView?
Before NextView, I got into the venture capital business by joining Spark Capital. I originally got into the internet space by joining eBay about 13 years ago in a product management role over there. And before that, I was a management consultant, and I grew up overseas. So I was born in the Philippines, and I grew up in Hong Kong before coming to the States.
So you were at Microsoft, and then you went to Spark?
I was at eBay.
Oh, eBay, that's right.
I was at eBay. I came back here for business school. I did some work for some startups in the area, but then joined Spark ultimately.
Okay. So why did you want to go into venture capital?
You know, I never thought I'd go into venture capital until I guess I got pulled into it. I always thought I was going to start a company or stay in product management or join more startups. Ultimately, I realized that venture capital was a business that I thought really suited sort of the way that I was designed as a person. It allowed me to sort of scratch my itch around like trying new technologies, thinking about where the future's headed. It allowed me to have a lot of like one-on-one interactions with people. Like, I'm not the most extroverted person, but I do like sort of meeting people, hearing their story, trying to help. And as a VC, that's kind of what you do all day long. Mm-hmm. And so that's a good fit. I really like the idea of when I got into venture, or when I was thinking about joining a VC firm, I had this realization that you should think about your career in terms of the activities that you care about, and try to map your career so that you do those activities at a high frequency all the time. And one of the things I realized was I really enjoy like games. I like playing games. I like thinking about like how do you develop an edge in a competitive situation. I'm a very competitive person. And I realized that like part of venture is like figuring out what your edge is or what your unique positioning is, or responding to the way competitors move or the market moves. And so there's an element of that I really enjoy that I think is, and you keep score, right? Like it's ultimately an investing business. And so, there's kind of, you get to keep score by seeing how you do as an investor. And, that gets me excited. And then like, I think wrapping all that up, is this desire to be an integral part of innovation. I deeply believe that the biggest problems in the world are going to be solved through the application of technology, through motivated entrepreneurs who like care really, really deeply about problems. And so being part of that on an ongoing basis is an important way to spend my life.
So you're able to almost kind of like gamify your job by keeping track of, your investments and how they do and keep score, like you said.
Yeah, I mean, I actually don't like the term gamification.
Okay.
It feels gamification, I think, in a lot of contexts is a little bit of like a trick or a psychological tool to get people to engage when they otherwise wouldn't engage. So I don't think about it in that way. I think about it in terms of, one, it's a multi-turn game where, you're meeting new entrepreneurs every single day. You're investing in multiple companies. Your actions today have implications down the road with how other people will interact with you. And so like, I like that aspect of it where you can experiment, but your choices have repercussions down the road. And like, there's a game-like aspect to that I think is interesting. When I say keep score, it's that, it's an investing business. And so ultimately, like, you can boil down your performance to hard numbers. As much as I think some VCs don't really want to do that, I think that's, the nature of this job, and there's like nowhere to hide, right? It's like if you're a salesperson and you continuously miss quota and, you underperform relative to other reps, like it's really hard to hide. Like same thing in investing, albeit with a much longer time horizon and much more opaque metrics along the way. But there is still kind of this sense that your performance is transparent at the end. You're
able to measure the results.
Yeah.
So you're at Spark, and then what inspired you to want to start, your own venture fund?
Yeah, I think there are a couple things. When people ask me about the venture capital business, I always say that there are three problems with VC. One is that it's a lonely endeavor. Because you end up spending most of your time on the opposite side of the table, or at least on a different side of the table as the people that you interact with, right? Even if you're very aligned with founders, there are many instances where, you're not perfectly like alongside them the same way that a co-founder is or a team member is. So it's lonely in that sense. It's very negative. You say no a lot. You think very critically about businesses. I mean, you think critically about an entrepreneur's life work, and that's like kind of a hard thing to do emotionally. And then the third is that the risk of success is not that great, right? Like the average returns of VC are not great. There's a lot of luck involved, and as a junior person in venture, you don't have that many shots to be able to prove yourself. In a way, I feel like starting my own firm help to address some of those drawbacks, especially the first two, right? Because by being a founder with two equal partners, we just feel like we're building something new every single day, and we're trying to push the ball down the field every day together. And like that is a very positive experience, and it's also not a lonely one at all, right? Like I just feel like this sort of camaraderie and this sense of purpose, shared purpose, that I think you don't necessarily have as part of a firm that you join. And then the second motivation is there was a need for our product, I thought, in the market where the best funds had gotten really, really big. The cost of starting companies had come way down. And so there's this gap at the seed stage. There was a generational shift happening in the Boston market and the East Coast broadly around venture. And so there was this opening where we thought that the number of very attractive financing sources at the earliest stages weren't plentiful. And there weren't that many investors out in the market who had operational experience at high growth internet companies, of the nature that we wanted to invest in. And so we said, well, somebody ought to capitalize on this opportunity. David and Lee they are my partners that I trust very, very deeply. And, it was an opportunity to work together, hopefully for, a very, very long time.
What was the generational shift that you mentioned?
It was sort of the shift in the types of companies that VC firms invested in, frankly linked also with the performance of those venture firms over a period of time, also linked to their how effectively they managed generational transition as partners aged and they brought in new partners. I think that without naming names, there were a number of firms in Boston that haven't done that great of a job at this. And so as a result, you had, there's a common lament among entrepreneurs that like the investors in Boston don't get it. They're out of touch. They're not very founder friendly. They don't have the relevant expertise for the types of businesses that are being built, et cetera. I think that that has changed in many ways, but there was this whole shift that was happening and a real opportunity.
Did growing up in the Philippines and Hong Kong, is there anything from that experience, be it the culture or anything else, that you've been able to apply to running your own company?
Yeah, I'd say so I wrote a blog post a few years ago when my father passed away that speaks to some of this. It speaks to what I learned from him, but I think a lot of what I learned from him was born out of necessity, given that he was an entrepreneur initially in the Philippines and then in Hong Kong. I think a couple things is, in the United States, there's a much more like well-defined path towards like success, financial security, a reputable job, that sort of thing. In a developing country, it's much less defined. There are a lot more entrepreneurs doing whatever it takes to build businesses and to try to survive. And their motivations in a way are like a lot less glamorous, right? Like there's we like to talk in the States about like, and we do too, right? Like we love to invest in company behind and with founders that have like this deep passion for this problem they're trying to solve. Like my dad was just trying to like survive, and he saw an opportunity and he would start businesses to try to capitalize on that opportunity. And, there's something about that scrappiness that is just different than, and I think this is true for a lot of immigrant founders, right? Like the scrappiness that exists as an immigrant that is just different. There's the willingness to kind of do whatever it takes, and to do whatever it takes in an environment or a context where you feel like you have no idea what you're doing or you're totally out of place. My dad, I said this in my post, he confided to me many years, late in his career, that he actually didn't have a language that he would consider his native tongue. Can you imagine that? Like he grew up speaking a dialect of Chinese, which was different than the dialect of Chinese he spoke in Hong Kong. He was schooled in English, but he never felt comfortable speaking English relative to like an American or European person. Like he had all these things such that like he lived his entire life speaking a second language, no matter what language he spoke. Like, can you imagine doing that? Like that was just an amazing thing to me. And, that's something that I try to be wary of, or at least to think about when, as an investor in new frontiers, like you just have no idea what you're doing a lot of times, and you got to be comfortable enough comfortable enough with that uncertainty.
Be comfortable being uncomfortable.
Mm-hmm.
So a couple of years ago, I think it was, you wrote The Hitchhiker's Guide to Boston Tech, right? Can you tell us what inspired you to create that?
Yeah, I thought
what it is also.
The Hitchhiker's Guide was originally a blog post that I wrote, and it's now become its own microsite called the BostonTechGuide.com, if anyone wants to check it out. My realization was that Boston is such a unique market within sort of the tech and startup scene, because there is a huge amount of inflows and outflows into the community. And inflows largely driven by the education institutions, right? So you have, a huge number of people who are entering this world every single year. And so it's very unsettling. At the same time, a lot of the universities are pretty siloed. And so, it's very easy to like enter this weird place and just be consumed with life within that university setting and then leave, when the broader market, the broader sort of Boston tech community has so much to offer. And so the original inspiration was to be able to create a really easy guide that sort of spoke the language of the people who are entering the market, and made it very easy to get plugged in and feel like you were connected to the broader tech community, no matter how you got into this market. Since then, it's kind of broadened much more greatly to not just be focused on students, but to sort of anybody who comes in and out of this great city. So I think it's been helpful. It was originally a blog post that we did every couple of years. It got a pretty positive response, and so we've invested more heavily into building a bigger presence for it.
Well, it's been very helpful for me, both learning about, the Boston scene and also finding people to come on the show.
Great. I'm glad I can help you.
Yeah. Thank you. What do you think makes the Boston startup scene unique?
I think it is that inflow of talent. It's pretty unique to have literally the smartest people in the world coming through here. People of a very wide range of disciplines from a very wide, diverse set of backgrounds, all entering Boston at sort of their prime, sort of the early prime of their lives. And so I think that is really unique. And, it's part of the reason why this has been historically such a thriving center for innovation, and why I'm really bullish about its future.
Is that through the local universities?
I think it starts with the universities, and then, the universities lead to very dense talent pools within the companies locally, and the creation of new companies that then kind of have this flywheel effect. I think there's a lot of people who lament that the Boston community is one where a lot of our smartest people leave every single year. And I really don't see that. I mean, that is unfortunate, but it's just the nature of this market, right? Because you have so many people who enter, you will have a lot of people who leave. Yeah. So rather than worry too much about that fact, I think a lot more about how do you just create the best environment so that the people who are here have the best experience possible and build the greatest things. Or set themselves up to be able to do the most ambitious things that is their heart's desire, and whether they stay to pursue that more fully down the road or whether they leave, I don't think that that's something to worry about too much.
I want to talk a little bit about how you value your time, because when we went to set up this interview, I noticed that you used the AI assistant Clara, right? And I thought that was really interesting. So can you talk a little bit about that?
I think, like many people, time is sort of my most valuable commodity, resource. Yeah. And so, I have to try to be as efficient as I can be. At the same time, I don't want to be too robotic about it, because I feel like you need to make room for serendipity. Brad Feld, who's a sort of world-class investor and an early supporter of us, he's, I don't know if this is so widespread, but he's blogged about it publicly. He sets aside time for random meetings. I think he calls it his random day, and he just jams in, every random request that he wants to take up for the month. He jams into random day, and he just has all these random meetings, and it allows for serendipity, which sometimes, creates really interesting things. So he met David Cohen at Techstars on his random day, and that was sort of one of the genesis points of the Techstars program, which has gone on to be fantastic. So, I try to be really protective of time and efficient, but you also have to build in the opportunity for serendipity. So that's really the biggest challenge. The AI assistant, as a side note, is particularly... I've been thinking about it because there's been this huge rise around AI as a mega theme. Scheduling meetings is something that takes up a lot of our time if we don't have a method to manage it. I used to solve this problem through a product within a calendar application called Sunrise, which we were investors in. But Microsoft bought the company and, pun intended, sunsetted the product, or is sunsetting the product. But that had the most elegant scheduling tool ever created. I wrote a blog post on it if anyone wants to check it out. But because they were sunsetting the product and I was interested in AI assistants, I sort of invested a bunch of time trying everything. And so far I've been pretty happy with the Clara product.
Is there anything else in your life that you automate? Or you're thinking of automating?
Depends how automated you mean. I have 3 Amazon Echoes, if that says anything about me. We have a bunch of Nest thermostats. I bought this. I forget the name of the company. I'm basically in the process of trying to find the lowest friction way to to make my home smarter. So I do that. I use a robo-advisor for any of my investments that aren't in NextView. Whatever's not in NextView, which isn't very much, I guess. So that's automated. Trying to think about what else. I don't know. I think there's probably a lot of little things that I do to create automation.
So let's talk a little bit more about seed stage funding. Mm-hmm. So what do you enjoy most about focusing on seed stage companies?
The most enjoyable thing, so there's 2 things. One is that at the seed stage, you really feel closer to the creation of something from nothing. And, there are many points that in the development of a company that are really critical, like major decision points. So I don't want to take anything away from folks who focus on later stage investing or the efforts that founders and executives go through to bring a company to fruition. But a part of me just didn't get as jazzed up about trying to identify companies that were already working and trying to help them work better. Like, I'm just excited about the opportunity to find things that are still searching for product market fit or have barely uncovered something, or even at the earliest stages, like it's just a team trying to figure out whether there's a there and trying to be helpful in creating something. That's just like a personal motivation, right? Like that's how I want to spend my time, and that's what gets me excited. The second is the earlier in the life of the company you are, the more potential you might have to affect the trajectory of that business, because it's a blank slate. Your choices like compound, right, as time progresses, and the teams are usually small, so you can make much bigger shifts in strategy or direction when you're an earlier stage company. The further a company progresses, the more there's inertia and just like momentum to a business, and the harder it is to change the trajectory or the direction of a company. So I just like that ability to like really be at a nearly at a blank slate for many of these businesses.
What are the top few things that you look for in a company?
So like all things, so at the seed stage, I think the most important thing is the founders and the founding team. And the most important thing we actually think about for founders is founder market fit, or founder, How well does the skill set and attributes of the founders line up with what the opportunity is they're going after and the unique needs of that opportunity at the earliest stages? And so this is very nuanced, right? Like when and this is part of the I think some of the drawbacks of investing in Boston early on. There was a big emphasis on like let's back proven winners, repeat founders who've done it before, which is fine for founders who've done it before when what they've learned from doing it before is very, very relevant to what they're doing next. There are very few instances of repeat founders who end up starting subsequent companies in completely different spaces and are as successful as they were early on. And on the flip side, right, there are many cases where you have first-time founders who are starting a company for the first time, but their personal experiences or their prior work experiences lend them to have the capabilities that are uniquely well suited towards a challenge that they're going after for the first time, and may even be better positioned to do that than a more experienced founder. And so we think a lot about sort of founder market fit. The second thing, around founders is quality along those dimensions tends to exhibit a power law, where essentially we're trying to find people who are really exceptional at certain attributes. I think where we've gotten into trouble has been more when we've backed companies or teams that were solid but safe, as opposed to exceptional in some ways but deficient in other ways. I think the returns that you get as a founder and as a founding team by having a couple attributes where you're like off the charts, even if some areas are deficient, end up being better than teams that are sort of like just solid across the board. So that's something that we look at. The other thing is we think a lot about like actually having product market fit. Is this a product and a market opportunity that is really, really compelling, that can lead to a very large, sustainable business down the road that is truly disruptive in nature. And so, that's something that's what we think at. There's a bunch of different like sub-dimensions to that, but those are some of the areas.
Do you have any, taking the other side of that question, do you have any deal stoppers, that for you say, like everything for a company can be perfect except say one or two things? If these things are present, then you never go on with the investment.
Funny enough, we had an offsite a little while ago, and we talked as a team about like what are our deal killers, sort of like what are we willing to do that almost no one else is willing to do, and what are we not willing to do that some other people are willing to do. I think for me, at the time, mine was this concept of founder market fit. And even more than that, it's the deal killer version. So the opposite, right? Like the deal killer version of this founder market fit idea is academic founding stories. So companies where, the concept of like, well, let's get a bunch of smart people in a room together. Let's go to a whiteboard and figure out a company to start. Like, that's just not my cup of tea. I just think that it's hard. It's so hard to build a company. It's so hard to find a unique advantage that unless you have some unique insight that is authentically born out of your experiences or unique perspective outside of like whiteboard brainstorming, it's really hard to be successful. And it's just not the type of situation that, I want to get involved with.
Mm-hmm. The like starting your own company just to start a company sort of thing? Yeah.
Yeah. If I get a inkling of that, it just ends up being tough for me. The other thing I don't like, and this is a little bit more of like a random nuance, but it signals this, right, is sometimes you hear a founder talk about a company and they talk about their business as a play, as in like, so this is a marketing automation play. And then I'm like, a play, that makes it seem not like a company that you must build. It's more about like one of many plays that you could potentially run. Like it's a little bit, I don't know. It's just not, it rubs me a little bit the wrong way. Like obviously, like there's no like one word or phrase that would say like, oh, I'd never invest in this company. But those are I'm looking for hints that make me say that, gosh, this feels like more like an academic endeavor than sort of passion-driven, authentic business.
How have the valuations for seed stage companies changed over the last, say, 10 years?
It's scary to think I've been in venture almost long enough to be able to actually go back 10 years. At a high level, they were seed stage companies, let's say 8 or 9 years ago, were raising their seed rounds at pretty low valuations, like $2 to $3 million valuations, sometimes less. Forget accelerator rounds, like those are a little bit different deals. They went up pretty dramatically, peaking probably about 2 years ago, sort of at the height of the Y Combinator frenzy, where a lot of companies are raising rounds at like with uncapped notes. And then I would say that valuations have come down pretty dramatically in the last couple years or so. What has changed though is that the round sizes for the average round size have gotten quite a bit bigger. So while the pre-money valuations have come down, because round sizes have gotten bigger for certain seed deals, the post-monies have come down, but not as much. If that makes sense.
Do you think that there are benefits to raising smaller seed rounds over larger seed rounds?
I do. We've written a bunch of blog posts on this. I think, actually, my partner David wrote a blog post recently, which is probably the best way to illustrate this, which is that there's an atomization of seed, which is what we called it, which is, the idea was the seed was the one round that you raised before you raised a typical round of Series A funding, right? What we've seen in the last few years is seed has really become the Series A round of financing for a business. After the seed round, the Series A and B investors at this point are really looking for traction, like a lot of traction before they put their money in. And so as a result, like the path for a founder to go from, early founding team to a business with serious traction sometimes isn't a very linear path. Sometimes it requires one round of funding. It might require multiple rounds of funding. It may require multiple rounds of funding of very different sizes and different sort of like circumstances. And so like we've kind of have this realization that you can't really, there's not like one size fits all anymore. So as a result of that, I tend to recommend that founders attempt to start out raising less capital out of the gate, because in the early stages of trying to search for product market fit, more capital doesn't really help. More capital actually helps once you have something that's working and you want to like kind of step on the gas and grow as fast as you can or create like as big competitive moats as you can. But in the earliest stages where you're trying to figure out whether you have something that works, more capital like ends up being consumed, but it doesn't end up being consumed in a way that like really gives you an advantage relative to less money. So I actually think there's advantage, but it's hard to have a one size fits all, because there's some scenarios where you have businesses that you just can't accomplish very much with $500K. Yeah. And so if that's true, then it's like, well, you're raising money to get you to like a milestone that doesn't really like change the nature of the business. And what you want to do when you're raising capital is try to raise money towards like value inflection points, so that you and your investors kind of get compensated for all the work that you've done, and you raise your next round at a much better valuation as a result. So you want to, if a business can't get you to a milestone like that, then you probably want to raise more money.
What do you think has caused that shift of Series A funding now looking for more traction?
I think it's pretty simple, actually. We're in a macroeconomic climate where there isn't a huge amount of growth in very many places. Private technology is an area where there was perceived to be a lot of growth. And so a huge amount of capital worldwide has gone into the pursuit of some of these companies at the late stages. This is also sort of fueled by this notion that, there's only one or two companies that matter. And if you can get into those one or two companies at any valuation, you'll do great. It doesn't really matter what valuation you get into. And so you have all this capital searching for growth. You have this belief that you want to try to find these one or two companies, and they just piled into all these companies with that belief that everything will work out okay. If you're a Series A or Series B investor, you start to say to yourself, you know what? There's all this money that is looking to market my investments as long as I have any level of traction at any price. And so as a Series A or Series B investor, I don't need to invest in early stage companies where I have to think too hard about it. I just need to find things that have any level of traction and pay whatever price it is for me to get in, because somebody else down the road is going to invest at an even a higher price, because of course the company is going to grow faster because I just gave it a bunch more money, and this thing's going to continue until everything starts to fall apart. That's starting to happen now, right? We've had this huge correction in valuations for a lot of these unicorn companies. And many of these companies are just going to go completely out of business, and it's going to be a really unfortunate period, I think, because some of these could have been really good companies, or at least, had the inklings of really interesting businesses, and they're going to collapse under the weight of too much capital. So anyway, because that was the environment, Series A and Series B investors started to invest later. They were rewarded for investing later. And so they raised bigger and bigger funds. And when you have bigger and bigger funds, the idea of investing, $5 million into an early stage company doesn't seem that much fun anymore, and a lot of work when you could invest, $20 million into a company that's growing like crazy at whatever valuation you want. Right. So I think that was part of the reason why that happened.
How can investors make themselves attractive to founders? And how does NextView do that?
That's probably a question for founders more than us. But I'll give you my 2 cents.
Sure.
I don't think most investors, I said this earlier, right? I really think of ourselves as having a product that we're selling, and our product happens to be value-added capital, and our customers happen to be entrepreneurs. And we think very hard about how do we make sure that our product is really a great fit to what our customers need at the moment that they want us, right? I don't think a lot of investors think about things that way. And so, what does that mean? It means an investment model that has a high degree of alignment between investor and entrepreneur, right? So if an entrepreneur is raising $1 million, do you really want to raise $1 million from a fund that has $500 million under management? Or not even under management, $500 million in their most recent fund? I don't know. It's hard to really, believe that you're going to be treated with the full amount of attention that you hope to have as a founder, right? And so having an investment model that fits what entrepreneurs are looking for is really important. Having kind of an approach and a front of the house, so to speak, that lends itself towards great collaboration is really important, right? Not all funds have that, and that's something that we think is really important. One of our ethos points is this idea of being an invited guest at an entrepreneur's table, which is something that we stole/borrowed from Greylock, that coined this concept, right? That's really important to us, that it's not an entrepreneur's, they're not lucky to meet with us. We're eating at their table, right? That's something that we try to hold dear to. And then when we think about our platform and what we offer, it's very much tuned towards what founders need at the earliest stages, right? So, we have a few initiatives that we don't talk about publicly around recruiting and talent. A lot of VC firms have HR partners or in-house recruiters. We don't have in-house recruiters because most in-house recruiters are focused on helping you find your next executive. Seed-stage companies are very rarely looking for executives. They are looking for a different profile of team members. And so we try to have a program that helps with that. Seed-stage companies also are for the first time just figuring out how do I get great at hiring people? How do I set up an HR infrastructure that can compete with Google because I'm going to go after some of the same people, right? And so we have a program around helping founders do that. But everything is around this lens of like, if you're trying to go from 0 to 1 as a company, what are the things you practically need to do? And we try to help you solve those problems and like build infrastructure to be able to support that.
I like that. And you help them, you want them to feel like they're a priority of yours, like you said before.
Yeah. I mean, that's another thing that we talk a lot about is that we're a one product company. That product is a high conviction, hands-on seed stage investment. And so if you're a seed stage founder, that's, we presume, what you would want. I make this analogy that we're kind of like Red Bull. We kind of only do one thing. Red Bull probably has a couple other flavors now, but like for a while, like they just did one thing.
Yeah.
I kind of believe the focus player always wins, and that's what we try to be.
You can't get distracted by, like other companies that may be growing really fast, but they're not seed stage. And so it's just, you don't look at them, right? Just by that rule. Yeah. So how has your strategy for investing changed over time? I
think it's actually changed very minimally, honestly. Okay. If you go back to our very first investor deck, our current fund is twice the size of our first fund. So some of the numbers are like a little bit are bigger, but right. The core investment model has been pretty consistent. I think what has changed has been just like a more of a crystallization of like what I just talked about. Like, what does it mean to be a seed stage investor? What are the services and the things that you want to provide companies that make you the most attractive product that they would want to buy? This idea of atomization of seed means that you do have to be a little bit more flexible when you think about the types of rounds that you're a part of and what types of companies you're investing in. So because, in any given day, I might meet a seed stage company that is 2 people coming out of a startup with a very, very raw idea. And then my next meeting might be a company that's been around for a year and a half that has like, $50,000 a month in revenue. And everything in between, right? Like all of a sudden, that's all seed. And we try to be effective investors in all of those scenarios. And so we've had to think a little bit more deliberately about like, okay, so if it's what's known as a pre-seed, what does that look like? What are the milestones associated with that? What's the right kind of capital strategy around that? If it's a more mature company, what does that mean, right? So that has created a little bit of, I'd say, a refining of the strategy, I'd say.
You mentioned in a blog post that I read that you love investing in a weaker market. Can you explain what you mean by that?
There's an old Warren Buffett quote, I think, that says, you want to be fearful when others are greedy and greedy when others are fearful. And so when you're in a weaker market environment, it's a great time to be aggressive and to try to invest in companies for a bunch of reasons, right? Like practically speaking, valuations tend to be better. Competition for talent tends to be less fierce. There's, your own competitors are distracted because they're all trying to survive themselves and deal with the fact that the market environment sucks. And, your bigger competitors are also on their heels because they're trying to make quarterly numbers and, or they're laying people off. And so they're not thinking about like the next important strategic initiative for their businesses. And so there's a lot of reasons why, weaker markets have often produced some of the most interesting companies. Twitter was founded in a really weak market. Uber was founded in a really weak market, like right after the economic crisis. There's a pretty large number of these. LinkedIn was founded after the internet bubble burst. So, there's a lot of examples like that. That's not the only time when you want to start a business, but in a way, it kind of simplifies simplifies things a little bit when the markets are bad.
Does valuation play a role at all in your decision-making process?
It does. We like to say we're price sensitive, but not cheap. So it plays a role. We have a very good sense of what we think are market terms for an investment. And if we are going to deviate from market terms, there has to be a compelling reason why we're doing that. At the same time, we're also not trying to get the best deal we possibly can just because we can. Because I think that in some cases, you can have a great deal, but it really impairs the long-term viability of a company down the road if you set this precedent where founders own too little or there's this, there are really punitive terms in the beginning, which all later investors will want to have similar terms as well. And so, our term sheets tend to be very, very clean, very simple, easy to execute, and we think pretty fair.
So what advice would you give to someone that wants to raise money?
So I'd say I'll start broad, and then you can drill down in any way. I think there's a mindset that's really important to raising capital, and it's about raising money to win as opposed to raising money to survive. So there's an adage that capital is oxygen, which means that you need capital to survive, versus another adage which is use capital as a weapon. You want to raise money because it's a weapon, not because it's oxygen. And I think that that's kind of a mental model that you want to have when you're going out to raise the financing. And it actually you'll find that if you have that mental model, it'll tune even the way you create your slide deck. It'll tune the things that you're focused on, as opposed when you're making the pitch and what you're going to emphasize, right? Because if you're trying to survive, it's a little bit more well, if we just had a little bit more time, or if we just had a little bit more money, here's all the things we would do, right? Using it as a weapon is more here are all the things that we're going to be able to accomplish, and here's all the we've already proven this. Imagine what more we're going to be able to do with this capital, right?
Yeah.
It's just a different kind of mental approach to raising financing, and I think that it also ends up reflecting kind of the mindset of the founder around pitching their business. Some people really lament fundraising. VCs, by the way, have to fundraise too. We don't just, it's not all our money, and we don't just snap our fingers. But I think, especially at the early stages, I often will counsel founders, fundraising is something you're going to do for the life of your business. And if not fundraising, it's going to be selling in some way, right? You're always selling. And when you're fundraising, you're kind of always selling ahead of reality. You're selling promise, backed up by results, but you're always trying to sell a little bit more than you have, right? And that's what you're doing with employees. That's what you're doing when you're selling customers. That's what you're going to do if you decide to sell your business. If you decide to go public, that's what you're going to do just to sell public market investors, right? This idea that you're kind of the evangelist for your business is not going to go away, so you better get used to it, and you better love it, or learn to love it, and think about using this as a weapon and not as a means of survival that you reluctantly pursue.
Yeah, I think that's a good point. Think of it as a weapon. It's not, all because you raise money doesn't mean you've won. It's not the end, right? That's really just the beginning, and just something that you can use to help you win.
Mm-hmm. Yeah.
Right?
I mean, I love talking about Wayfair because it's a Boston success story. My wife works there. Near's the Steve our advisors to our fund, but they bootstrapped the company to hundreds of millions of dollars in revenue. They did raise money. They raised money because they said to themselves, we could be at the time, we could be 10 times bigger. They're now 10 times bigger. They can be 10 times bigger than they are now by raising outside capital and becoming a household name that stands for something, as opposed to a great business that sort of leverages great execution advantages on marketing and operations, right? Wayfair, a lot of people don't know this. It was originally a CSN store. It's a 12-year-old company or something like that, maybe older than that. But the Wayfair brand itself is only 6 years old. They raised money to build the Wayfair brand and become the dominant player in the home category, which was a very offensive and aggressive thing to do, as opposed to we need this because we need it, because they didn't need it.
So you mentioned that VCs have to raise their own money too. So what has been most difficult for you in raising your first fund?
First funds are always tough to raise. I would say the general challenge if you're doing anything interesting is that it hasn't been proven yet, right? You're hopefully doing something. So Peter Thiel has this concept of being non-consensus right, if you've heard of this. So two concentric circles. One is everyone thinks is a bad idea, and then another circle is a good idea, and the little sliver of overlap is where you want to be. But the idea is that if everybody thinks that what you're doing is great, that means that it's already been proven, and so the amount of competition has eroded away any advantage that you have. If everyone thinks that what you're doing is stupid, you could very well be stupid. So there's a lot of risk, right? So, as a first-time fund going after a new investment model in a geography other than Silicon Valley, there are a lot of questions because it hadn't been done before, right? And it wasn't proven. And so, that ended up being the challenge that we had when we got started, and is a challenge that all founders have, I think, if they're doing something really interesting. Thankfully, venture is a very long-term time horizon towards proving success and repeatable success, but I think we've gotten off to a good start, and I think the market has perceived that, but there's a long way to go, and you're always kind of in this process of one, selling what you're, convincing people that what you're doing is great, and two, making sure that what you're doing is great.
What advice would you give to someone that wants to join an early stage startup?
Advice that I would give, and it's been echoed a couple times by other folks on the internet, so this is nothing earth shattering. I actually think that if it's your first time joining an early stage company, I would probably not worry too much about stage. A lot of people want to join an early stage company, and that means like two people in a garage, or a very, very early stage company. It turns out you actually learn a lot more at a mid stage company where there's still like more responsibility than there are people, but something's already working, and there's a layer of management that is like really, really strong, right? The company's had enough success that they've been able to hire, people who have seen like very large scale success at other companies. The product's working, which creates more advantages, right? Like you actually do learn more from success than you do from failure. Like it's kind of unpopular to say, but like success creates opportunity and certainty that you otherwise wouldn't see, which will be more useful down the road in other companies that you're going to join. So I would say one is don't worry too much about stage, and be willing to trend later than you think. Mm-hmm. The second is focus more on companies that are winning than companies that you think are interesting, because of the same reasons. Like companies that are winning end up being interesting. Companies that are conceptually interesting but are going sideways, you actually don't end up learning as much as you think.
What do you think separates a great founder from a good founder? Are there any traits that you notice?
I don't love answering this question because I don't like boiling down all founders into a few attributes. I would just say that we tend to be more attracted to founders, as I said, who are exceptional in a few dimensions, even if they're deficient in others, as opposed to founders who are solid across the board. So that's what I'd say.
Okay.
Another thing that and one of the ways that we look for that is, when we make our reference calls, our ears really perk up when we hear, we talk about this internally, superlative references on specific dimensions. Even if a founder actually doesn't have like the most unique background in the world, like there was a founder that I had invested in years ago, and he had worked at Bain & Company. That was kind of his only job before business school. Great place to work, but like, it's not that unique of a background. But then, so when I did a reference on him, I talked to, a manager who'd been there for a long time, and she said, or my question was, so how does this person stack up? Like, you guys hire dozens and dozens of people every single year, and you rate everybody. So like, how does this person stand out? And she said, oh, he was the best, like the best of his class. She's like, no, best I've ever seen. Right? Like wow. That says a lot, right? Like yeah. To be so superlative in some way is an interesting feature. Similarly, for Sunrise, the founder Pierre and Jeremy, when I did reference calls for them too, like we heard the same thing, right? Like it takes a lot for somebody to say that somebody was the best they've mm-hmm. seen. It's very easy to say they were excellent, but to say they're the best, not a lot of people say that.
What mistakes do you commonly see made by entrepreneurs who are seeking funding?
I'll share something that's not that fancy, but like I think pretty practical. We see a lot of founders who come in asking for too much money, and then like come back a few weeks later or a few months later and then ask for a lot less money, at which point you've kind of lost all your momentum. When otherwise, if the founder had come out asking for a more reasonable amount out of the gate, they would have had like a lot of interest. Mm-hmm. So, my advice is counterintuitive, which is, think about how much money you want to raise and ask for a little less. And then you will end up raising more than you wanted because if the business warrants it, because investors are lemmings to some degree. And once you've gotten a couple people to commit, it tends to steamroll on itself. And then you're in this position where you can turn money away, or you could increase the size of the round and renegotiate the deal a little bit with your lead investor. And there's usually a fair bit of flexibility around doing that. So I usually encourage founders, like, target 20% less, and you'll end up raising more.
Why do you think they come in initially asking for so much?
Everybody's very optimistic. I mean, if you're not optimistic, like, you probably are not a founder of a tech startup. And so everyone is optimistic and they want to create a buffer. This is your chance to raise money. May as well raise as much as you can, which is true, if you're going to raise money. But when it comes to the ask, I think you need to have a pretty good sense of, like, how the market is going to perceive the amount that you're going to ask relative to the milestones you're trying to achieve for your business, which is hard to figure out, by the way, given that most founders, you're not thinking about this all day long. And then it's scary to like not build in too much of a buffer unless you're pushed by founders, by investors to do that. You don't want to go, like, overboard and, like, have a unreasonable ask, because to some degree that, like, hurts your credibility too about, like, your ability to plan your business. But I find that a lot of founders try to raise more just to raise more. And I think that can hurt you.
The more is better mentality, thinking that more money would lead to better results.
Mm-hmm. We've had some of, even within our own portfolio, companies that have gone out to raise a Series A, in our opinion, were asking for too much, didn't get much love, quickly shifted to asking for a lot less, and ended up getting the exact same amount that they were asking for from the beginning, right? Or more. It's just funny how that psychology works. So yeah, that's more of that's not like the biggest issue that we see, but I think that's a very practical thing. Yeah. If you're a founder listening to this, to think carefully about that.
I want to move now into our rapid fire questions.
Okay.
Not necessarily rapid fire answers. So what's something about you that most people don't know?
Most people don't know I'm not a U.S. citizen.
What was your first investment and why did you do it?
First investment was in a company called Rent Juice. The founder, I did it because I thought the founder was exceptional. He is exceptional. His name is David Vivero. He did, like, end user facing SaaS when everyone else was doing Web 2.0 companies or, like, large scale enterprise. He taught himself to code when that wasn't cool and when there weren't coding schools to do it. He was able to ultimately recruit a technical co-founder that, like, he had no business recruiting. Like, it was just unbelievable, like, what he was able to do, and his sheer determination and that sort of, like, resilience was really what attracted me to invest in him and his company.
What about your most recent investment?
I'm trying to think about what's the most recent one I can talk about. We're investors in this company called Dia & Company. It is a home fashion discovery and e-commerce company focused on the plus size demographic. So, I think it was a phenomenal market. First, again, phenomenal founders. I just thought it was a phenomenal market opportunity. A huge percentage of women in this country wear a size 14 or above, much larger than you would ever think. It's a completely underserved market. When you think about both the traditional retail experience and the online e-commerce experience for apparel. And there are very few brands that are, body positive brands that care about style and care about this demographic. And so, I really see an opportunity to build a huge company that, delights millions and millions of women in this country and across the world as well. So very exciting company.
Do you have any favorite books or blogs besides your own?
My favorite blog is Wait But Why, if you've ever read it.
I love that one. Yes.
I just think it's awesome. It's so awesome. Favorite books. I really enjoyed Ready Player One. That's a really good book, although now everyone's read it, so it's not that special anymore. The Martian. I mean, my wife likes to say I have the book taste of a teenage girl. She says I like these dystopian fantasies quite a bit.
Okay.
So I end up reading a bunch of those. But It's not exactly high literature.
What advice would you give to your 25-year-old self?
I was starting to learn this at the time when I was 25. But I've blogged about this idea of high failure strategies. So I feel like, traditional education and traditional careers lead you to take approaches where your probability of success at each juncture is relatively high, right? A high failure strategy is one where, as a strategy, the probability of success is high, but each incremental step has a very high probability of failure. So what's an example of that? Within the venture capital business, there's a firm called Summit Partners. This is more in the growth equity business. And they really pioneered this idea of hiring a bunch of analysts to cold call companies and as a way to source investments. I think a typical analyst at Summit will source less than one deal every 2 years. And they'll make I don't know how many calls a day, 25 calls a day, maybe more, probably a lot more than that. Somebody from Summit will probably get mad at me for misquoting everything. Most people are very, very uncomfortable with any strategy that resembles something like that because the pain of failure is so great, because we've been trained to always avoid failure. But there are some problems that are best solved by these sorts of high failure strategies. It's kind of like, a product version of this is kind of like, do you figure out the most, or maybe like a mathematical thing, right? It's like, do you figure out the most elegant algorithm or mathematical equation to solve a problem? Or do you just create a simulation that just runs through every single variable and gets you the answer? For some sorts of problems, creating a simulation is a lot easier and probably the more practical thing to do. So that seems a little weird, but I find that there are more places than you'd think where that matters a lot. A lot of people ask me, especially coming out of graduate schools, how do I find a job in a startup? And my advice is think about 3 criteria: sector, geography, and role. Choose one that's a non-negotiable, and then make your list of 30 companies, if there are 30 companies that match, and literally talk to every single one. And most people are very turned off by this idea of talking to 30 companies or talking to 50 companies or 100 companies. And that's the only way to do it, because everyone who's done that has found a job that they love. People who are too reluctant to start or wants to have a high success rate end up in very mediocre and not exciting kind of positions, right? So I was starting to learn that when I was 25, and I just wish that I had learned that sooner, but that's something that I've internalized over the last 10 years.
How do you recommend those people reach out to those companies? Is it through just calling them or emailing them? Or
the nice thing about a high failure strategy is you have a lot of opportunities to experiment.
Okay, I like that.
And seriously, that is the answer. That is what people
try
say.
Different things and see what works.
Rather than listen to somebody give their point of view, sure, do that, but you can try a bunch of things, right? You can run experiments when normally you wouldn't think that they're an experiment, right? It's kind of like with your podcast, right? You just told me that you sent a bunch of emails and people bit, and so you started a podcast, right? Why not?
Exactly.
That may have failed. That would have been a high failure strategy if everyone said no, right? But that's okay. It was easier to try than to think about trying.
Can you talk a little bit, if you can, about your anti-portfolio, the companies that got away from you?
There are a lot. There's always a lot. I'll talk about two examples,
sure.
Just more because they're fun stories. One was a company called 2U, which is an online education company, founded by a guy named John Katzman, who was the founder of Princeton Review, and started 2U, and he started some other companies too. And it was my all-time favorite pitch because it was so simple. He was basically bar none, online education sucks. We're going to make it fucking great. And that was his pitch. That was basically his pitch. Right? Of course, he had actually done amazing things to make it happen. And I'm not going to go into the details, but it was just, I found that actually the best pitches have this level of clarity that is okay, if that's the bet, that's the bet, right? Yeah. And so they were an online education company that actually charged a premium over the normal education, right? That's a little counterintuitive. The other one, so another company, there are two companies actually, DraftKings and ClassPass, both of whom had founders or co-founders who had worked for Vistaprint, interestingly enough, and were customer acquisition monsters. So it kind of got me looking into the what is it about the DNA of Vistaprint or people with that background, and it kind of helped me develop a particular profile of founder that is that I intend never to miss again. And irrespective of what happens with both those companies, both of those companies have had some challenges or questions down the road, and so but I remain very optimistic about these founders that I'm thinking of, and wish that in one case I wish we could be in business with him, Jason. In another case, we are in business with her through another company. So excited that that's true.
So what do you think it is about the founders coming out of Vistaprint, or do you think that was just a coincidence?
I wrote a blog post about this actually. It's deeply analytical. It's deeply analytical, such that they can handle very high stakes decisions incredibly well, because you're very dispassionate about it. They're hyper analytical, so they're completely objective, and they're willing to take calculated risks and be very bold about it and not worry about looking dumb because they're very rational. The second thing is there's something about the culture of that company. I don't know if it's still the case. It probably isn't still the case, but at one point in time, that was where the standards were incredibly high and the people were incredibly competitive, and sort of willing to do whatever it takes to win. And that's something that I've seen in these founders and some others too.
What Boston startup excites you the most?
Not in our portfolio?
Yeah, not in your portfolio.
I think PillPack is a really interesting company. Very authentic founder, huge market, big entrenched players that really need to be disrupted, and a core product that I think will make people's lives better. So I think that's a really exciting company.
Just a few more questions here to close out. Where can people find out more about NextView?
You can go to nextviewventures.com. We have a whole section that it links to that is our platform, which includes our blog and other resources that we put out. We have a podcast called Traction, which hopefully people enjoy. I think it's pretty interesting. You can follow me at RobGo on Twitter, or all of my colleagues are pretty active on Twitter and on Medium, and starting to be more active on Snapchat. Jay Akunzo, who leads our platform efforts, is very active on Snapchat, so I'd recommend, if that is your medium of choice, follow him as well.
What's his? Do you know what his Snapchat handle is? Okay, that's fine. I'll add everything you mentioned. I'll put in the show notes so people can find it. Do you have any parting thoughts, advice, suggestions for the audience?
I think my parting thoughts is, Boston's a really special place. It's a special place because of the people who come through here, and the way that we keep making it special is to do whatever we can to build great companies that attract the best talent and, really influence the broader community, our local government, to do the things that it needs to do to support innovation and keep this place competitive. So my encouragement is to embrace what's great about this ecosystem, and get involved.
Rob, thank you so much for doing this. It's been a real pleasure being able to speak with you.
Thanks very much for having me. I appreciate it.
Don't forget to enter into this week's book giveaway for The Power of Habit by subscribing and writing a review on iTunes. By subscribing, you'll get all of my new episodes automatically fresh onto your podcast app. So make sure to do so, and it really helps me out in the rankings and with acquiring new listeners. I really, really appreciate it. Remember, all show notes can be found at startupbostonpodcast.com. And make sure to follow the podcast on Twitter at StartupBossCast. That's Startup BOS Cast. Thank you for listening, and until next time, if you have any feedback, ideas for guests, or just want to say hi, you can reach me at nick@startupbostonpodcast.com. That's NIC@startupbostonpodcast.com. Cheers.